This conference will now be recorded.
Okay, we are ready for Chapter 3 and Chapter 4. We're going to combine the two, especially since Chapter 4 is very short nowadays with fewer and fewer deductions allowed on the 1040. Chapter 3 will never probably be a short chapter with lots of items that are considered as income. That's what we're going to focus on first, is what's considered income and what's not. Before we start, most taxpayers, especially smaller businesses and just individuals, will use the cash method to prepare their taxes. And the reason is this wherewithal to pay concept. In Accounting 101, when we were doing accrual accounting, you could easily record revenue and maybe have a high amount of revenue where nobody has paid yet, and it's all coming in as an account receivable. If you collected a whole bunch of revenues at the end of the year but didn't receive the cash, it may be tough for you to pay the tax with cash you don't have. So therefore, with the tax method compared to the accrual method, the tax method mainly uses the cash. You can use accrual, it is allowed, but again, most people use the cash method. If you ever hear of people having two sets of books, usually the reason is because they have a tax or a cash set of books, and then an accrual set of books, like in Accounting 101, where they would provide to investors or banks or anyone else who may need to see their accurate portrayal of their books. In taxes, there are three types that we're going to look at, and the reason why they're broken down this way is by general rule, you can't offset one with another type. So if you have active type wages, you can't necessarily offset those and have a negative amount of investments and then they offset, or passive. That's generally why they are separated out, but that's not the only reason. A couple of the other reasons, like earned income credit, these would definitely not be earned income, the final two here. The first one is mainly all of your earned income. As you can see here, the passive losses, this is the main one that cannot offset these two items. So if you have a negative here, you're only going to be able to take a negative off of another positive in this same area. There is one big exception for the real estate, and we'll get to that at the second half of the semester. But for right now, I just want you to know that there are three types of taxable income: your wages, your stock type income, if you have any dividends coming in, or interest from stocks, or capital gains from stocks, that's going to be here in number 2. And then number 3 is if you are a part owner of maybe of a partnership, but you don't do any work in the partnership, you're just kind of an investor. The other main one is real estate, is a passive type income. The main one we're going to look at a lot is the active wages. Active wages, let's look down here at some of these very common ones, things that we're going to see a lot, things that are going to come up in this as we do tax returns. Definitely going to see W-2s with our wages. Tips are definitely taxable. Every time if you're a waiter or waitress and you receive a tip, you have to keep track of all of those, and most of you know that, but they are taxable. If you don't report them, your employer will set an arbitrary amount, and that's what they feel you probably would have collected based on the average tips of that type of establishment. Interest dividends, there's not a whole lot to these, but we will look at these in just a little bit. Unemployment, that's pretty common, especially for back in 7, 8, 9 years ago when we had the big downturn in the economy. This was very, very common. Retirement income, yep, all of this good stuff. A business income, hobby income. We'll look a lot at hobby income when we get to the second half of the semester and we look at businesses. These items are not nearly as common, but you still need to be aware that they are taxable. Prize is one. What that means is if you would go on a radio show and you answer the question, you're the 9th caller and you win a trip to Jamaica, you will be taxed on the value of that trip, even though you didn't get any money. If a trip's valued at $3,200, the radio station will send you a 1099 saying you have to claim $3,200 of income. Same thing with if you go into The Price is Right and you win a car. A lot of people don't actually take home a car that they win because they can't afford the tax. If they win a new Cadillac, that new Cadillac may be $60,000. You would have to add that $60,000 to your income and therefore pay a large amount of tax on winning a new car that you thought was free, but really it's not free. So most people have to turn it down, or they take the cash equivalent and whatever The Price is Right is offering as a cash equivalent in that case. If you get money for a scholarship for room and board, taxable because it's not specifically towards education. Just living expenses are not tax-free. This one's kind of one that you have to pay particular attention on. If you get a refund from last year's taxes for the state, so if in Indiana you filed a state return and you received a $120 refund, it all depends if that $120 needs to be added to your next year's tax return. And the answer is it does not if you did not itemize on your federal return last year. And we'll see more about that, why that is, when we get next week in itemized deductions. But essentially, if you did not itemize, you do not have to show, and you shouldn't show, the amount of refund you got from your state tax. If you did itemize, basically the rule is you have to report the lesser of how much a refund you got or how much your itemized deductions last year exceeded your standard deduction. I'm not going to get into a lot of that right now. This is not that common, but just know that the primary thing I want you to remember, if you don't itemize, then you don't have to pay a tax on your state refund. Non-cash, this would be if you traded 2 services. If you're, say, a dentist and you wanted your, there's a guy who shovels snow and you say you'll give him a free cleaning if he comes and shovels your driveway. Whatever you would have normally charged to any normal person that's not trading, that's how much you have to include in your income, even though you didn't receive any. So any barter or trades do have to be recorded. Damages for non-physical personal injury. A lot of times these are for mental, whatever it may call it in the legal world, mental strain, or if it's non-physical, if it's not like a broken bone recovery, then you are required to report that and pay tax on the amount of damages you received, especially if the damages are punitive damages. Punitive damages basically are out there to punish the guilty party, and you just happen to be the recipient to get the extra windfall. And then any gains from illegal activity, the government can definitely not only arrest you for dealing drugs, but they could also arrest you for tax evasion for not reporting the income of those drugs that you were dealing. Okay, non-taxable items. These are just as important to know so you don't accidentally record these, or that you may want to try to get your income in these type of items. All right, so gifts. Anytime you receive a gift, it's not taxable to you. The person who may need to do something special is the giver. If the giver is providing over $15,000 to you in gifts, whether it's cash or property, then they have to file a gift tax return. Now, each person can give $15,000. So your mom could give you 15 and your dad could give you 15, and neither of them would hit that threshold. And then your mom could give your wife 15 and your dad could give your wife 15. So there's a chance you could get $60,000 and nobody has to do anything. But you, as the person receiving the gift, never has to do anything. And inheritance, nope, you don't have to do anything with that either. That's already taken care of, if any, at the estate level before you get the money. Any money you receive as an inheritance is tax-free. Anytime you receive a scholarship that goes directly towards tuition or books, tax-free. Now, the caveat there is if you receive a scholarship and it's more than your tuition and books, the amount that's left over that you still get and you get to take as a refund, that is taxable. Lots of people do not know that and are very surprised when I show them that on their tax return when we do taxes here every year. Let's go down. Child support payments. Anytime you receive child support, not taxed. However, just the opposite though, the alimony, that law is kind of changing, but any type of divorce before 2018, alimony is taxable. Child support though is never taxed. Any type of very low income welfare or TANF type payments, not taxed. You won't receive anything from the government for that amount of money. Workman's Comp, if you get hurt on the job, that is not taxed. Any type of money you might receive while you're not working, that's just free income. But don't confuse that Workman's Comp with unemployment. Unemployment is taxable. Okay, unemployment is simply you don't have a job. Workman's Comp is you got hurt on the job and you're still receiving some pay. This is a big one. People may have $2 million in income in a year, and I actually knew some, didn't actually know them, but I knew the person who was preparing their return who had a client that had over $2 million of income this year or the last year and did not have to pay a dime in taxes because it was all in municipal bonds. They had maybe 50 million in municipal bonds and 2 million that was received in interest. It is considered tax-free. Not a dime was paid. Anytime your job reimburses you, except for moving expenses, that is tax-free. And here are a few other not very common ones, but still non-taxable. Anytime you receive life insurance, that's a good one. Anytime this is something you should know. Anytime that you may be getting a wreck and it's not your fault and the insurance company pays you to restore your car, that's not taxed. It's getting you back. The key word there, the key thing to think about with taxes is it's simply getting you back to where you were before the accident. It's not improving your condition. It's just getting your car back to that normal state. Meals and lodgings, if it's for the employer's convenience, meaning it would be too hard for you to go out and find a meal because you're in a very isolated location, or maybe you're out on an oil ship far out in sea and you have to have a place to sleep because there's no way they're coming back to the dock every night, that amount of lodging would not be taxable to you. I thought this was a pretty neat one to think. Should somebody receive free hamburgers from McDonald's because they mentioned their McDonald's hamburger or their Big Mac? Watch this article. I thought it was pretty interesting, or this video, and read the article that goes along with it. You may remember the case. It was in Ohio about somebody who was held kidnapped for quite some time, and then this guy happened to find her, called 911, said he was eating his Big Mac, and he was on TV saying he was eating his Big Mac when this girl came forward. And then McDonald's privately offered him I don't know if it was lifetime or a year, but free food. And should that be taxed? Because basically what the key here is with any prizes or rewards, if you did anything to get the prize, it is taxable. Well, and in this case, all he did was make a call and mention McDonald's. He didn't really do anything to try and get the prize. He wasn't trying to get free Big Macs. At least that's what the story is. So if you came on down to The Price is Right, you had the intention of winning a prize, then it is taxable. We've talked about gifts and inheritances. These are not taxed. you can kind of read the summary here of the McDonald's case, kind of what I thought was the important parts on if you should or should not be taxed, and you can kind of make that decision. I thought it was pretty interesting. Again, you don't have to read through all of this, but I thought it was kind of interesting to see some of the exceptions. I'm not going to go through it right now. That's something you can easily read. Okay, tips. What I had mentioned before is if you don't report your tips or you're not reporting enough, your employer is responsible to assign to you tips that they feel you probably would have earned in a similar establishment. These tips, especially, you're going to be shown that you didn't report all your tips if they were less than 8% of your food and drink sales, unless you can prove otherwise. If you can prove otherwise, that you keep a detailed record of all of the tips that you receive and from all of the sales that are food and drink sales, not carryout. Carryout's different. Carryout usually a lot of times won't get tipped on that, so they don't count that against you. But if you can show that you kept a detailed record and you had 6 stiffs that evening, then you won't have that added on, and you won't be taxed for something you didn't receive. But simply the employer is responsible for tacking on tip income, especially for not reporting it. Schedule B. Schedule B is simply there to list all of your interest and dividends that you have received, and you got to list each one separately if either one happened to hit the $1,500 mark or more altogether. If your interest was over 15 or your dividends were over 1,500, then you just simply have to list each interest and each dividend. Otherwise, you can just put the entire amount. If it was $800, you could put the entire amount right on line 2 of the 1040. So Schedule B is nothing big. All it is basically a sheet divided in half with rows, maybe 10 rows of interest for you to write down all the places you got interest, and then all the places you got dividends. And the only reason you have to do that is if they were over $1,500 total, all of them together. Annuities and pensions. So how much interest and how much of a return on an investment should you be taxed on? Well, if you ever put money into an annuity or a pension, basically what that is if you put money into an annuity, you're paying, say, $1,000 for this year. I'm just going to give a real easy example, and they're going to give you back $100 every month. So you're paying $1,000 up front, but you're going to get back $100 every month for $1,200 at the end of the year. That would be an example of an annuity. So then how are you taxed on that? Should you be taxed on every 100 that you receive? No, because most of that is just a return on your investment. Only the little piece of the 200 extra that you received, because remember you got 1,200 total versus 1,000 put in, only a 1/12 of that 200 total interest that you should have to pay taxes on every month. What becomes a little bit tougher then is if it's an annuity over a lifetime. If it's an annuity over a lifetime, then you don't know how much you're going to get back. It's not just a nice neat 1,200. You may get less back than you put in because you died early, or you may get a lot more. So how much interest then should you have to record versus how much is a return on investment? That's something we can figure up using some tax tables that we have in our book. So the one key thing to remember is the amount that you originally put in, what's called a return on investment, not taxed when it's paid back to you. Only the amount over and beyond what's paid to you is taxed. And then that's going to be prorated. Every time you receive money, a little bit of it's going to be taxed while the rest of it is a return on capital. So if you look in the book, I'm going to turn to it now because I'm going to do an example. Page 11-27. We'll get to this chapter specifically after we have our midterm, but it's good to look at just tables right now, and we're going to specifically look at the table on, it's not 1129, I need to update that, it's actually 1120, it's 1129, not 1127. Table V, Roman numeral for 5. So what we have to do whenever we have an annuity or a pension, because it's going to happen, you're going to have a 1099-R or something similar. It's going to say the amount received and then the taxable amount. The amount received will be easily filled in by the company, but the taxable amount may or may not be filled in when it's a pension or an annuity, because they may not know how much is taxable. You may have received $1,200, but the taxable amount really should have only been $200. You don't want to just assume that it's $1,200, because that'd be taxing your own money twice. All right, so the first thing we have to do is find the expected return on the investment. So in my $1,000 and $1,200 case, the $1,200 was our expected return. That was pretty easy because it was a set amount of time, like in this case, 5 years. In my case, it was just over 12 months. If it's a lifetime, it's not as easy to know the total return value. It's a guess. We have to use the tables, and the tables will give us what they're designed to do is tell you on average, this is how much longer this person could possibly be expected to live. And that's how we want to determine how long they're going to be receiving payments. So I have an example here. If I put in 120,000 and I'm going to receive 500 a month every month until I die, how much money should I expect to receive? So if I do it for just a year, that's $6,000. What I need to do then is figure out how long do I expect to live if I'm 50 years old. And if we just use the basic charts, if we go to 11-29 for a 50-year-old, you'll see the age is 33.1 years. So they're going to tax you like you're going to live to be 83. Whether that's true or false, that's just the number you're given. And so your expected return would be 198,600. Your original investment's only 120. The difference then is what you need to pay tax on over every time you get money. So we need to find that percentage, the amount you've put in and over how much do you expect to return. And that's step 2. So there's only really 2 steps. Step 1, find the expected return. And then step 2, all we've got to do is simply do the math. Come down here to our Part B example, 120 divided by 198. So every time I get a payment of, up here it was $500 a month or $6,000 a year, every time I get $6,000, 60.42% of that is not taxed. It's a return on what I paid. So therefore, if I know how much is not taxed, I can easily then determine what is taxable. So on the 1099-R, when it says I received $6,000 and box 2 taxable amount is blank, I have to go through these steps and determine how much of that $6,000 is taxable. And the key thing you really have to know is, what was my original investment? And sometimes that's not the easiest thing to find either. All right, so the final piece is, well, what if I live beyond 83 years old? If you live beyond 83, that means you've received your entire return back as an investment. Therefore, all $6,000 that you receive after the age of 83 is taxed completely in full. All right, so let's look at these couple examples. I don't know if I have an example A or B, if I just got rid of them, but we can use this. All right, we'll just start here with C. Tommy pays $150,000 for a 5-year annuity that pays $3,200 a month. So using the example above, pause the video and work through the amount, work through what each one of these 3 should be, and we'll go through the answers here in a few seconds. Okay, so the first part says, what is the expected return on the investment? I know how much I'm going to get. I'm going to get $3,200 per month over 5 years. So I can take 3,200 times 60 months. That's probably the easiest way. And that tells me I'm going to get 192,000. If I put in 150 up front, then I can determine that exclusion ratio. That's the next thing I need to do before I can figure out how much is taxable each month. So 150 divided by 192, this tells me that 78.125% is going to be not taxed out of that 3,200. So that comes up to be $2,500 not taxed. 2,500, that's on a per month. So 30,000 over the entire year is not taxed. What is taxable? Well, all I did is took 100% and minus this. There's different ways of going about it. This is just a second separate way. 100 minus this number gives me how much is taxable if this is the not taxable amount. So 3,200 times that number, $700 a month or $8,400 a year. Box 1, how much is taxable, would be $8,400. Okay, this would be a retirement, a pension. Jack's paid in $15,000 to his pension for the year. So that's not a whole lot, because it's not just, I mean, $15,000 in the total time in his whole career, he's paid in 15. He's receiving $23,000 just this year. So this $15,000 was a little bit every year for several years. He's 67 years old and he received a 1099 showing that he received $23,000. This would have also had to have been on the 1099 somewhere that I can't remember what box, but it says the amount originally invested by the taxpayer, 15. So what I want you to try to do is take a few minutes, hit pause, and try to answer these questions, and then I'll go through them here in a few seconds. Notice this is a lifetime annuity type. Okay, with this one, the first thing we got to do, the expected rate of return, we've got to figure out how long does the tax tables say he's going to live. If he receives $23,000 a year, so $23,000, and we look at the tax tables for a 67-year-old and it's 18.4 years. Again, the same table we were using, table Roman numeral 5. That tells me we expect to receive a little less than $500,000. I only put in a measly $15,000. So nearly all of the money that I get back, the $23,000 every year, almost all of it will be taxed. Only a very small portion won't be. So we do the percentage here, how much is going to be not taxed. Notice this, it's only 5% is going to be non-taxable when we do the math. So $1,249 would be not taxed, therefore the difference. Line 1 would have said, line 1 I believe would have said 23,000, how much proceeds are received. Line 2 would have said how much is taxable. Out of the 23, still most of it, but we can take it down a little bit to 21,751. Okay, again, this is a kind of a recap of what we had looked at. State and local bonds are not taxed. It does show up, and you do have to put it on your tax return. It does, and you put it on line 2A of the 1040, but it'll be down lower on the 1099 INT if you actually have income that is tax-free, interest income that is tax-free. This after-tax return rate, I'm not going to go through the math, but basically what this is saying just because you're getting a lower rate on maybe a municipal bond, 7% compared to 8.5%, depending on your tax bracket, the 7% may be a better option because you're not paying any tax. If you're in this high tax bracket, the more tax that you can avoid, the better. So if you're only gaining 1.5% here, it may not be worth it. It may be better to take the lower rate and have it all be tax-free. That's what this after-tax return rate is. You can work through those to see what's going on. Okay, with dividends, our next main item. So interest up above, that was line 2 of the 1040. Dividends are line 3. Dividends are going to be either ordinary or ordinary but qualified. The key thing here is all dividends are ordinary. So if you received $1,500 of dividends and 1,000 of them were considered qualified, you would have 1,500 as total dividends, ordinary, and then separately stating 1,000 of those was qualified. You wouldn't say 500 ordinary and 1,000 qualified to total 1,500. No, your total has to be in the ordinary box, and then how much of those totals is qualified. And you can see the rules here for something to be qualified. You want it to be qualified for tax purposes because note how much tax you pay compared to your normal rate. If you're in the low rate, if you're in the lower brackets, from what we talked about back in week 1, any dividends you receive aren't taxed at all. It's a great benefit. If you're in the middle brackets, they're taxed at a lower rate than you would have normally had. And at the very top bracket of 37%, you're still getting a nice deal. You're only taxed at 20% on those dividends compared to being taxed at 37%. So much better. It's much better to have qualified dividends compared to just regular ordinary dividends. When you have kid earnings, kid type income, the general rule is the kid needs to have their own tax return. Now you will probably prepare it and need to sign it, but the kid should prepare their own tax return, especially if they have earned income. The parent cannot take on the kid's earned income. And a lot of times it's better for the kid to have their own return. We may need to pause at this point with, I got somebody logging in. Whoop, okay, now they're gone. Get back to what I was thinking. Okay, the kid has to file their own return, and a lot of times it's better because they're going to be at a lower tax bracket than what the parents are. The parents may earn 50, 100,000 when you combine the two parents, where the child may only have 10,000, and they're going to be in the low tax bracket where the parents may be somewhere in the middle. So a lot of times, just the key thing here is kids should file their own return, even though it's filed by the parent. You do not combine the earnings. There are a few instances where you can, but most of the time it's not worth it. Child care, I thought this was something interesting a long time ago. I had found out if you happen to be one of the little bit more wealthy and you have earned 20 and you have a nanny that comes to your house and you pay that nanny at least $2,100, they are considered your employee. And you have to actually take payroll deductions. Most people probably don't know about this, but maybe if they're in the high tax brackets and they have a CPA do their tax return anyway, they would. But if you have a stay-at-home nanny, they are supposed to take out taxes out of your paycheck and not just pay you straight. If you know of anybody or you or yourself were a nanny, I'm curious as to if that ever happened for you. Qualified tuition programs. There is nothing that can happen on your federal income taxes. You can't, if you put money into a Section 529 plan, you don't get any deduction. However, it's beneficial for the child or whoever's going to be receiving the Section 529 plan because they don't have to pay any interest on the earnings. Typically, if you put money away, like for retirement, by default, if you put money away, you're going to be taxed not on the amount you put away, but on any earnings that you receive over and beyond. So if you put away 1,000 and then it grew to 2,000 or 3,000, you would have to pay tax on that 2,000 growth. If you designate it as this Section 529 or qualified tuition program, you don't get a deduction on your current year tax return, but anybody who receives the money and uses it as it should be doesn't have to pay tax on any of the earnings. So that's a nice thing. Alimony rules. We're gonna kind of go quickly past this just because Indiana is not an alimony state. But the key rule is if you receive what's considered alimony and had a divorce decree before 2018, it is taxable for you to receive alimony payments. However, anything you receive property-wise is not taxed until you actually sell it. So if there was property distributed, a $20,000 property, it's now worth 30, you don't have to pay the $10,000 gain until you would actually sell the property. And if you sell it for 30,000, then you would pay the tax. So the giver's gain or loss, or anybody's gain or loss, would be 0 in the initial divorce decree. The receiver's basis would be the original 20. And then whatever they sell it for, if they do sell it, that is going to happen at some later point. That's when the tax would incur. We've talked about the life insurance proceeds. These are not taxed. They are paid at death, or a couple other little tiny possibilities that could happen. If you are considered terminally ill, you can receive these life insurance. That means you are going to die within the next, I think it's 12 months, but it may be 24 months. A doctor or two has, both of them have decided, yes, you are terminal. You can use the money to go and splurge if you would like. Although it's usually life insurance is to help pay for funeral and to help maybe your spouse live more comfortably after your death. Gifts and inheritances, we'll come back to that after the first part of the term, but basically they're just, again, no tax if you're the person receiving the gift or the inheritance. This amount should have been changed to 15 and 30. Meals and lodgings, I already talked about this. If you're out on a ship, you can't get meals or lodging. That would be free. Otherwise, if you're working at a factory and they have a cafeteria and they give you free food, that is considered taxable. Okay, Social Security, we're about done here with Chapter 3. The Social Security benefits. Is the Social Security you receive taxable or not? And the answer is it depends on the amount of other income you have. MAGI, this is called your modified adjusted gross income. Okay, and where Social Security goes, it goes right on the 1040 towards the top, line 5A. This is the full amount that you receive, and line 5B would be how much are you actually taxed on your return. So modified adjusted gross income, what that includes, without any Social Security, take your opening AGI, which is right there on your 1040, and then add in any of those tax exempt interests. That's why you have to put them on there. Remember those municipal bonds in line 2A. Add that in. Add in now 50% of whatever you received in Social Security, and then a couple other items to add back in. This one is now gone. So basically just adding back in the educational interest that you may have deducted. When you get to that amount, that will be your modified adjusted gross income. If you are married filing joint and that MAGI is below 32,000, you won't have any tax on any of your Social Security. If you're head of household or single, basically, and your MAGI number, all of this added together, is less than 25,000, no tax. If you're in between, then you're going to fall here. If you're over, the key basically is if you're over, then you pay 85%, or you have to report 85% of whatever your Social Security is. So if you had maybe 10,000 in Social Security, and you did happen to fall with all your other income above one of these two numbers, out of that 10,000, you would have to put 8,500 on your tax return as taxable income. Okay, so let's work through the numbers here just to see how this works. I give an example. Your MAGI is 36,000 and you're married filing joint. So you're in the middle. We're going to find how much of that 22,000 of Social Security you received actually needs to go on your return. Okay, so the rule is we take the lesser of 50% of the benefit. So 50% would be 11. Or 50% of our 36,000 minus the lower amount. The lower amount being 32. So 36 minus 32, take 50% of that, 2,000. Well, there's a huge difference here, and luckily you get to take the lower of. So out of the 22,000 in Social Security that you had, only 2,000 needs to go on your tax return as being taxable. Okay, here's a second example, and this one, actually go ahead and take the time and do it, and then we'll go through the answer. You have an AGI without Social Security so you're going to have to figure out what is your modified gross income when you take in all of this information. And then once you know that, how much of it is taxed. And this shouldn't say line 20B, it should say line 5B now. This is okay. Go ahead and pause, and we will go through the answers here in a few seconds. Okay, so for my example here, our MAGI, we don't just use the 22,000. We have to take 22 plus the 4 at that back, and then add in half of the Social Security. So we got 26 plus 6 is 32. That's my base number. If we're single at 32, and I don't know why I'm like, there it goes. We're single at 32, notice we're in between. So we're gonna have to do this formula. All right, so the first step, 50% of 12,000 is 6,000. So I either have to put that down or the lower of 32 minus 25. Take 50% of that. So that's only 3,500. What I'm actually going to have to record on line 5B is 3,500, the lower. If I'm married, notice I don't exceed the lower base. So therefore, I don't have to include any of it. None of the Social Security would show up as taxable income. Gambling, generally, if you win any money gambling and it's over a certain threshold, the gambling location will take out 25%, not knowing what tax bracket you're in. They have to take a guess, and the IRS says go ahead and take out 25%. Some will need to have taken out more. Some will be a lot less, but you'll do that when you do your 1040, you'll settle up. So if they took out too much because you're only in the 10% bracket, then you'll get a lot of money back when you file your return at the end of the year, beginning of next year. Here's some of the kind of thresholds of when the casino has to step in and actually start withholding money from your winnings. Otherwise, they don't withhold it, as you may or may not know. So just some interesting facts, I thought. And the final thing that I wanted to go through is items that are specifically not taxed because they are written into the tax law as an employee fringe benefit. So just quickly, I'm going to go through some of these. If you receive money from your employer and the employer puts money into your flexible spending or health savings account, any of that money not taxed, which is great. That's free money you're receiving to pay on medical items. Now you have to follow the rules. You can't just use that money for anything. It has to be for specific medical items that are allowed. You can, the HSA, what the rules are for an HSA, how much your deductibles have to be at least to be included into an HSA. The big difference between a flexible spending and an HSA is with the flexible spending, if you don't use your money, you lose it. Whereas with an HSA, it's a better plan, but it's only for high deductibles because you don't lose the money if you don't use it. You can keep putting money away for a really bad rainy day and you're not going to lose it. Let's get down, no additional cost services. So if you work on an airline and you take a free flight somewhere, that would be a no additional cost service if the airline didn't have to kick somebody off of a seat to get you on. That's of course not going to count, but most of the time they wouldn't do that anyway. That would be considered a fringe benefit. You don't have to have the value of that airplane ticket added into your tax or taxable income. Number 7 is a very one a lot of people use and don't even realize it perhaps, and this can be, depending on the clientele you work with, what's considered a fringe benefit and what's not can be argued. Is of course things like using the copier for personal purpose of sending a fax. It's no good way to actually tax you $1 for every fax that you send for personal purposes. That would be very cumbersome for the employer to do. But what about things like having a cell phone? Is a cell phone even considered a fringe benefit, to determine how much of your cell phone was personal use versus how much was business use? That's where it gets to be a little bit more gray. And finally, a huge perk of working at a college is that you and your spouse and your dependents can get free education, and none of it is going to be taxable as long as it's mainly for undergraduate work. That's one of the key things there. But read through the rest of those of employee fringe benefits, things that you are good to have and good to look for in a company. What I would highly recommend is looking at the final practices at the end of the chapter. I've given the answers to these in our lecture document, lecture answers as well. They're at the bottom, as they will be on each week. With that, I'm going to briefly, this will take us about 5 minutes. I'm going to go through chapter 4. I've got chapter 4 ready. Chapter 4 is simply the deductions for the AGI. These are all going to be, I'm going to put this up here, on Schedule 1 of the 1040. If you want to take a break, I think this would be a good time, even though this won't take us too long to finish up. If you go to the Schedule 1 of the 1040, let's see if I have it, yep. I'm going to pull that up here. So Schedule 1 at the top is some of those items that we had just talked about, like alimony. We had talked about unemployment, potentially other income like gambling would go here. At the bottom part of Schedule 1 are all of the deductions that you can take off of your taxable income, but most of them are, if you read through these, aren't very common, and I'm only going to talk about the ones that are common. So these deductions, if you have them, you do have to have attached a Schedule 1, and they go on your 1040 right there at line 6 or 7. Can't remember off the top of my head. The educator expense, this is only applicable to K through 12 teachers, not college teachers, and they're allowed only $250 off of their taxes. And I stated here it's not a great benefit, because if you're in the 15, let's say 12% bracket, it's even lower. 15 was last year's bracket in 2017. 12% of 250 would be somewhere, I don't have the calculator in front of me, but somewhere maybe about $32 off of your taxes. So very, very small amount that you have off your tax liability. You may save $32 when you spend $250. So it helps, but not a lot. There's a place there for half of self-employment tax. You get to take back off your taxes. We're going to talk more about that when we get into having your own business at the second half of the semester. Self-employed health insurance. This is a big one on why it's in that it's here versus on Schedule C. It's one of the only items you're not allowed to deduct as a business expense for your personal self health insurance. If you buy your own health insurance, you cannot deduct it and therefore lower your Schedule C income, therefore lower your FICA taxes. Unfortunately, it doesn't work that way. You're only allowed to deduct it, which only helps reduce your federal and your state tax liability. So it does help, but it doesn't help for FICA taxes, which if you're just a regular employee, regular employees get to take that amount off of their taxes and for FICA as well. They don't pay tax, and you'd find that more in payroll tax. I'm not going to get into that, but that's a really odd little place. But you don't get to take off you don't get to take off self-employed health insurance on Schedule C. You only take it off on Schedule 1 as a adjustment for AGI. If you pay alimony before the year 20 and your divorce was before 2018, you can take off alimony payments. Key is they cannot be considered child support, or they cannot be acting like child support. You cannot take off if the person you're paying, your ex-spouse, still lives with you. IRA deductions, we'll get into this a lot more in week 9, right after the spring break in our first test. The key one with this, only thing that I really want you to know for right now, is you're allowed to deduct $5,500 per person, or $11,000 for married filing joint. If you put that much away into a retirement account, you get to up it by $1,000 if you are 50 or older. It's called a catch up. You're trying to catch up before you retire. You're putting more money in. The most common deduction still left is the student loan interest. And this is for any type of higher education expenses. If you took out a loan, you're allowed to take off any interest that you paid that year in student loans. So you'll get a form every year, a 1098E, and it'll tell you how much money you have paid in interest on your loan. If it is over $2,500, you have to stop. $2,500 is the most you can take, no matter if you're a single or married filing joint. So that's where a marriage penalty comes into play, because two single people could both take $2,500, but as soon as you get married, you're still only allowed $2,500. So that's one of the items where it's considered a marriage penalty. Notice there's also a few phase outs. If your income is above $80,000, you cannot take any deduction. If you're single or head of household, it's just over double that for married filing joint. You can take a deduction up to, if it's over $165,000, your AGI, then you can't. If it's in between this, then you can only take a portion. If it's below the first numbers, then you get to take all of it. What happens though if it's in between? Let me show you how I work it. It's a little bit different than the book, perhaps. The books I may have changed, but basically if you have an AGI of 70,000, so you're in between these two as a single, and you have student loan interest coming in at 2,800. So the first thing that comes to my attention is we've hit the cap, or we've hit the low end. So what we have to do is take the top phase out number in our category, 80, minus what we're at 70. So there's 10,000 left. And we divide that 10,000 by the entire span of the entire phase out, which is 15. So 80 minus 70, 10, divided by 15, says we're allowed to take 2/3 of whatever the amount would have been originally. So that brings me to the second thing I notice. We paid 2,800. The most I can possibly put on my return is 2,500. So when I take 2/3, I can only take what I could have possibly put, which is 2,500. I'm limited then to 2/3 of 2,500, which is 1,667. Here I give you another example for you to try to work it out and see how you do. The last thing, penalty on early with savings. You may see this every once in a while. This doesn't come up very often, but it is a odd item that you could deduct as an adjustment. Okay, with that, I'm going to have one other video that's going to go through a practice tax return, since we're getting into some more difficult items and where they go. That will be our second follow-up video.